Hi, and welcome back to the channel. Today I'm thrilled as we are delving into the topic of value investing. Have you ever wondered why value investing has historically been the most profitable approach to investing? How some private investors manage to achieve remarkable success with value investing? Do you also want to learn more about intrinsic value, margin of safety, and achieve long-term success? Then make yourself comfortable and enjoy this video. The origin of the term value investing dates back to 1928, when Benjamin Graham was a professor at Columbia Business School and was teaching this philosophy, which became a book in 1934, Security Analysis, where the author describes the investment process as the one that, thanks to a thorough analysis, promises safety of principle and an adequate return. This book was key for Graham's next publication, The Intelligent Investor, where the author further elaborated the concept of value investing by also providing some screens in order to find undervalued companies. Since then, and for almost a century, the value investing approach has created great fortunes for professional investors like, for instance, Walter Schloss, Charlie Munger, Joel Greenblatt, William Ruane, and in particular for one of the students of Graham at Columbia Business School, Warren Buffett.
Ben Graham taught me a way to value a certain type of company that would prove successful, except the universe of those companies dried up. But nevertheless, it was almost a guarantee against failure. But it was not a guarantee that these things would continue to be available. Charlie taught me a lot about the value of a durable competitive advantage and a really first-class business.
But how do we concretely define value investing? Well, it basically consists in finding superior businesses at very attractive prices and holding them for a long time, while on the contrary trying to tune out the short-termism and noise that lead the majority of investors to fail. So basically we do have three main components: the quality of the business, the attractive price, which can be translated in a market price which is less than the intrinsic value, and the investment horizon. In Graham's time, it was sufficient to study a business and to focus on the balance sheet in order to find out companies that were trading at a discount compared to their book value. Then Fisher came and told us to focus on the earning power. Therefore, value investors started to study also carefully the income statement, because it was fine to purchase companies even at a premium compared to their book value, providing that they were able to exhibit this earning power. Then there was another shift from the earning power to the cash flow generating capacity. Therefore, value investors started to carefully look also at the cash flow statement. Throughout all these changes in the value investing philosophy, however, two things remain the same: the cash flow generating capacity of the company and its ability to have a competitive advantage. So here it is a difference between a value investor and another type of investor. So for instance, a value investor compared to a speculator does not necessarily have to rely on the future disposal of the assets, hoping maybe that in the meantime the market has gone up, in order to realize a positive return, because the company has to be able to generate cash flow itself. In the book, The Theory of Investment Value, Williams set forth the equation for value. In fact, he wrote that the value of any business, stock, or bonds can be determined by the sum of its cash inflows and outflows, discounted by an appropriate interest rate, which are expected to be received throughout the remaining life of the asset. So, for instance, an NFT cannot be considered an investment value, according to Graham at least, because it does not possess an intrinsic value, meaning it does not generate the cash flows. So here it is a question: But how are we expected to estimate the cash inflows and outflows that are expected to be produced in the future? Well, according to the value investing philosophy, an investor has to stick to the business that he can understand, to its circle of competencies, in order to minimize the probability of making mistakes. However, we are all humans, and therefore the probability of making mistakes, especially when we are trying to estimate cash flows that will happen in 10 years' time, is quite high. This is why value investors are used to apply the margin of safety to their estimates. Value investors implicitly believe that the market price of a company will eventually converge to its intrinsic value over the medium to long term, therefore mirroring the company's fundamental in terms of balance sheet quality, earning power, and cash flow generating capacity. Therefore, adopting a long-term investment horizon is key not only to allow the strategy to play out, but also to defer the tax expenses that would have to be paid on our wins and that can be used, on the contrary, to further compound on our investment. I'm going now to break down the core of value investing into the four main principles I'm adopting as a value investor. A value investor would study a public company in the same way he would do for a private one. In fact, he would try to understand the business, study the competition, the main risk, assess the quality of the balance sheet, the earning power, the cash flow generating capacity. He would then try to figure out how much the entire business is worth and how much he is willing to pay for that. This he would do regardless of whether he's gonna buy 20% or just 0.1% of the entire business. But how do we manage to stay rational and not let the stock market turn us into trader or gambler? I personally like to ask myself the same question Warren Buffett was used to ask. What would I do if the market would close for 10 years? In fact, over the short term, markets are highly irrational, and therefore the forecasting exercise is extremely difficult. This is why adopting a long-term investment horizon becomes a must. Also, this allows you to play a completely different game compared to Wall Street, for instance, and consciously decide not to pay attention to those factors that might not have an influence at all on the business value. I personally incorporate this long-term investment horizon into my investment process into two main ways. First of all, I look at the balance sheet, income statement, and cash flows by trying to understand how they will look like in 5 to 10 years. And then by also trying to let my strategy run, therefore giving it time to the company to converge to its intrinsic value in terms of market price. Determining the intrinsic value of a business might have different nuances depending on the value investors you are talking with, but there are two components that will never change. How much cash flow the business is able to generate over the projected horizon, saying 5 to 10 years, and how much the business is going to be worth by then. What the market is showing you is just the market price of a business, not its value. This difference is very important because over the short term, the market price tends to change quite erratically, whereas the value of the business tends to stay constant. Once you manage to figure out the value of a business, everything that should matter to you is its intrinsic value, meaning that if the market price is below the intrinsic value, you buy the company. If the market price is above the intrinsic value, you sell the company. Seth Klarman wrote that the margin of safety is necessary because valuation is an imprecise art. The future is uncertain, and the investors, as human beings, make mistakes. Therefore, the margin of safety is what best distinguishes a value investor from other types of investors that are less concerned about possible future losses. So in the end, value investing is an approach that yields remarkable result over the long term, but that it might fall out of favor from time to time. In fact, probably because it is not a sexy approach, or because it does not look at the hottest stock of the moment, nor it rewards actively buying and selling stocks, it requires a lot of temperament and sometimes also a contrarian mindset.